Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we had more earnings. And this time it's a stock that you guys really seem to like based on the performance from the last video, and that is ZIM Integrated Shipping Services, ticker ZIM. If you want to know a bit more about it, we dug into the historical numbers in an earlier video, which I will have right here. And today we're looking at its performance since then and these earnings if they change anything. So getting right into it, we last looked at the stock 721 and we put it on the hold list because they had a down quarter, things weren't looking too hot, but it could have just been an anomaly. So we said a hold would be decent. They were paying a good dividend, and we were going to see how things went. And now we see how things went. And I think that it might be worth moving from hold to sell because the earnings were not good again. And you can tell by the market's reaction, it was down 10.27% today, down to just north of $12. So the last time we looked at it, the stock was right around 13 and a half, and then it ran all the way up to just north of 15, and well, it's back down now. So now we need to decide what's going on. So when we look at the numbers, we of course have the targets and the year-to-date numbers, and they came in with a pretty big negative on their earnings per share. They were expected to make at least some sort of earnings per share, and the fact that it came in uh, well into the negatives, over $1, it was like 107% miss to the downside. Of course, the stock's going to drop off that, and this is what it's leaving us with. So top line, they're kind of in line with projections, 49% of the way there, halfway through the year. It's not bad. They're expected to come in at 5.44. Last year, they came in at 12.56. So even hitting that is a huge drop off from last year. The cost of that revenue is up significantly. They are at 76% of the goal there. And that, of course, is not a good sign. And that means that they're running at a loss right now. They're making revenue, but it's more expensive for them to operate, which is leaving them with a gross profit of a negative 0.94% on the year. And we can see historically, I mean, this is the lowest that they've been. They keep saying that it's a rough time for them, but they went from 50% gross margins to negative gross margins. Their total expenses, just north of $3 billion, and they came out with a negative net income of $336.8 million. So they're coming out with expenses that are 112% of the revenue. So it, 2 quarters in a row, it is kind of a long-term rough spot if that is truly what they're going through. So far, they're at negative $2.29 for the year. They're expected to come in at negative 317, and they're ahead of pace for that. So uh, everything here is not looking good on the um, financial side. Shares, they have issued less shares than expected. We were looking at them to go from 120 million shares to 127 and a half this year, and they're not even to 120 and a half. So they might be slowing down that pace. They've kind of been all over the place on it. There's no consistency here. They went from 100 to 117 to 115 to 120. So we'll see how things shape up as the year goes along. It looks like it is another growth year, but a lesser growth year. So that is something good. Common stock equity is down. It's still above the 2021 levels, but it's below 2022. And we were expecting some pretty good growth there. So that looks like a trend that has changed. Free cash flows are minuscule at best. They're at 1% of the goal with the revenues that they're coming in with and all of their financials. That is no surprise that they're going to miss on that this year, and it's going to be a rough one. Assets are down. They've been really good at growing them, 82% year over year. They had a huge jump in assets this last year. And it seems like what the story is here is there was huge demand for their services during the pandemic. And they beefed up their operations and brought on equipment and personnel to meet that demand. And now that the demand has halved, they're running into some trouble. Their expenses are way higher than the money that they're making, and they're going to have to start to do something about it, whether it be finding new sources of revenue or getting rid of some of those assets that they had brought on. And it looks like they're getting rid of some of those assets. Liabilities are just barely up. So that is something good. It looks like they've got a bit of time. They can buy themselves getting rid of the assets, paying down some liabilities, continuing operations, trying to get back to an equilibrium and ideally that 50% gross margin. Debt to equity ratio was just shy of 1 this last year, so that was an okay number. And here's what the largest problem it seems for the stock is: their dividend policy. So, in accordance with their dividend policy, they will not be paying a dividend this next quarter because they distribute 30 to 50% of their net income to shareholders in the form of dividend. So that's nice when things are going well, but when they have a negative income, of course, you can't expect anything as a shareholder. So if they're coming in with these numbers for the next 2 years, we can almost assume that the dividend is going to be zero. So we have the first quarter dividend of $6.40 and a second dividend of $1.07. And I'm not expecting any sort of dividend from here on out. So if you had bought back in 2021, you're probably sitting fine. They came in with $38.49 in earnings per share last year and paid out $27.50 in dividends. And in 2021, they paid out $2.50. Now, granted, the share price was $58, so maybe more in 2020 if you bought then, you'd be sitting really pretty because the stock price is about the same as where you bought it, and you would have collected looks about $37.50 in dividends. So you would have gotten 200% of your investment in dividends alone. So that's where that dividend policy is nice. But when they're in a rough spot like this, it is not good. There's not a whole lot of consistency across this company, and it's pretty new to the market. So it definitely does need to prove itself here to the investors. It came onto the market in early 2021 at $4.63. So it's already 3 times that price over the course of 2 years, 2.5 years. So there's definitely more time for it. We've looked at other shipping companies. I do think that there's other better potentials, and I might do a head-to-head where I compare ZIM to them. But we can get into the trends to really see what's going on here. Essentially flat revenue. I mean, we can take out 2021 and 2022 and see a little bit of growth year over year, but like there's almost no difference between this 2023 and 2024 number. Gross, net, and EBIT, we see a similar story. I mean, at least nothing is super negative here up until this year's numbers get updated rather than just the goal. But it might be the reset that they need to shore up their operations. Balance sheet, assets, some nice growth, but they are dropping it this year. So this year it'd be more in line down here. Liabilities, essentially flat this year. So far at least, we're halfway through the year. They do seem to realize that they can't take out too much debt if the operations are going to continue like this. So they are probably going to keep this in mind. But tangible book value does look like it's pretty good. Cash flows, this is hopium right here. I mean, they're probably going to break even, if not come in negative this year. And next year, it's a whole new year. Maybe they'll break through this rough patch, they'll figure something out and go off to the races. We said the dividend, they have paid it 30 to 50%, and then they cut it. But the CEO's notes, that's what we really need to take a look at. And I've copied them from the earnings report. They say that we continue to take proactive steps to respond to the current market realities with a focus on minimizing cost while optimizing our commercial strategy. We've taken action to rationalize our existing capacity and routinely review our services to adapt our network to customer preferences and identify new commercial opportunities. We also explore opportunities to leverage operational collaborations to improve efficiencies. At the same time, as the year progresses and into 2024, we expect our cost structure to improve in tandem with the delivery of our highly competitive, fuel-efficient new build tonnage, including 29 LNG-powered vessels. Although our second quarter results reflected continued near-term challenges in the container shipping market, our total cash position of $3.2 billion at the quarter's end remains strong. We believe our ample liquidity and solid balance sheet will enable ZIM to operate from a position of strength and maintain a long-term view even during a prolonged period of market weakness. As we overhaul our fleet profile and advance ESG objectives for both ZIM and customers, we remain confident in the company's strategic positioning to drive profitable growth over the long term. Based on a soft peak season and demand that is expected to remain subdued for the remainder of the year, ZIM forecasts full-year adjusted EBITDA of $1.2 to $1.6 billion and an adjusted loss of $500 million to $100 million in 2023. Moving forward, we are committed to leveraging digital initiatives, enhancing our commercial and operational resilience, and further implementing our differentiated strategy to best serve our customers and generate sustainable value for shareholders. So they're just looking into the future, hoping that things are able to shape up better, but they are touching on what I mentioned here as their issue is they really need to streamline those expenses, bring them down, handle whatever assets that they brought on to deal with the increased demand, and bring things more in line with what they're actually experiencing. Because 5.4, it's really low compared to 2022, 2021, it's still about half. But 2020, they were shy of 4. So that is growth there. And at that point in 2020, they came in with $4.41 in earnings per share. So it might be a little bit, they can work out all the kinks in the system, but in the future, this might be a stock to watch. And we will definitely have it in a head-to-head matchup here soon to see how the entire shipping industry is doing. I don't think that these numbers down here are even reasonable numbers because the inconsistencies, and I mean, you can just look at it here. This year's expectations, negative $50 off earnings, $264 off cash flows, a balance sheet of $295. And we looked at that, how the assets are trending downwards. So that's definitely not going to be the case. And then a dividend that has been cut to nothing. Still bring $18 in value off what they've paid so far. But the fact that it's cut to nothing means it's essentially meaningless from here on out. So the best number that we have here is negative $50 for the value. And this next year, it would be negative $49. We will continue following earnings and see if things are getting better or if they're getting worse. But I am considering moving this stock from a hold to a sell because a huge decline in revenues, expected declines going into next year. consistently negative earnings. The trends that we liked have changed. I mean, at least there's a slowdown in the shares, but free cash flows are looking like they're going to be quite a bit lower this year. Assets are going down. Dividend is gone. So the thesis on the stock has kind of changed, and that's what it looks like a lot of investors have decided, because 10% is a pretty big drop in a single day on a stock. So that's what we're looking at here. Thank you guys for watching. Please like if you enjoyed the video, if you learned anything. Comment if there's any other earnings we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.